The reality for most Australians is messy. You've got mortgages, you've got rising interest costs and living expenses, you've maybe got kids, you've maybe got a business, you maybe have parents that need help, and somehow you're meant to follow a one-size-fits-all plan in terms of your financial growth. That's exactly where generic financial planning falls apart and why you need to forget these 5 things you need to do mantras relating to financial growth. In this episode of the Unlock Your Business podcast, we're going to discuss the use of trusts for high income earners and the suitability for SMSFs in discussing the importance of personalised financial planning along your path to financial success, security and independence. Hi, you're listening to the Unlock Your Business podcast, where we discuss ways you can unlock your personal and business wealth with financial, investment and business strategies. I'm Rafi Pelagian. I'm a financial advisor and run financial services businesses that aim to help individuals, families and small to medium business executives manage, grow and protect their wealth. Through this podcast, I share my experience and knowledge from a financial advisor and business owner's perspective, in addition to my wins and struggles. So if you want an authentic and honest discussion on personal and business growth, investment, management, and unlocking wealth creation strategies, you have come to the right place. The Unlock Your Business podcast is brought to you by financial advice firm Manly Financial Services. Please see the website links in the show notes. We hope you enjoy the discussion. Hi, I'm Rafi Pelagian from Manly Financial Services and welcome to this episode of the Unlock Your Business podcast. At Manly Financial Services, we're in the business of helping our clients achieve financial success, security and independence over the long term. Just like many other financial commentators, we started following the 5 things you need to do videos in terms of financial growth and success. These videos do paint a picture that there are easy solutions to quite complex considerations based on your financial situation and goals. But upon reflection, these instructions are more clickbait than useful and paint a general picture that's really not useful to anyone. Personalised financial planning really starts in a totally different place. It's not about products or hot tips. It's really about your life, your income, your cash flow, your tax position, your goals. Whether this is comfortably retiring, taking back some time in your career, or just feeling less stressed about money. Factoring in tax laws, superannuation regulations, and economic and market environment is really important in a more personalised approach to help clients achieve their goals. So let's look at a case study for high income earning family where you've got a husband and wife that are both PAYG earners, so they're employed and they're high taxpayers. Let's assume that they have kids, say both at private schools, and they're concerned about property affordability for their children, which is something that a lot of people are concerned about at the moment. Now, they're paying way too much tax and have sizable mortgage that needs to be reduced. So we need to come up with some strategies there as well. Now, they've got some cash and they're typically looking to build wealth over the medium to long term. As they're high income earners, their employer contributions of 12.5% are making up most of their, if not all of their concessional limit of $30,000 a year. And let's assume that their super is over $500K each, so we can't take advantage of any carry forward concessional contributions. Let's just assume that's off the table. So the question here is, for these high income earners, how do they invest their available cash? Now, generic financial planning says invest jointly or all of the assets in the lower income earner's name, right, for tax purposes. Now, net income after loan interest will be taxed at the owner's marginal tax rates, and upon sale, if the asset's held for over 12 months, the owners will receive a 50% discount on the capital gain before it's taxed, i.e. only half of the gain is taxed. This is where the ownership by one individual of a couple may not be ideal. So we've seen in many cases that a couple may have a high income earner and a very low income earner. In some cases, they'll have the asset owned wholly by the lower income earner. That means that any deductibility of depreciation allowances or interest that's funding that asset is not going to be as effective because it's owned by that one person. And upon sale in 20, 30 years, when that 50% discount does come in, they've got a large capital gain that's really taxed in the one person's name. On the other hand, if we were to have the loan and the interest and the ownership in the higher income earner's name because we want to take advantage of the depreciation allowance and the interest payments, when it comes to a CGT scenario, Actually, before the CGT scenario, the net income will be taxed at the higher marginal tax rate. And then when it comes to the capital gain situation, even if that person's retired, you're going to have the same sort of issue with all of the gain being taxed in the one person's name, even after that 50% discount. So in this scenario, net income could be taxed as high as 47%, including your Medicare levy, and capital gains at 23.5%. Now, we do have to remember that obviously tax tables are staggered, so someone earning over the top bracket will not be paying on average 47% in total, but we're talking about, I guess, the higher level as well here, where we say that net income could be taxed as high as 47% and capital gains at 23.5%. So taking a personalised financial planning approach, we can start to look at other structures. Now, this is more of a costly and time-consuming approach for a financial planner, but it's really important to be able to give this personalised, value-added advice, particularly for individuals that are either high taxpayers or they've got specific situations, specific issues and problems and are outside of the status quo, if you like, in terms of financial planning. And we see this for a lot of our clients that, as I said, are either high income earners, have large amount of assets, or small business owners, private wealth clients. So let's consider utilising a company or a discretionary family trust for these investments, as opposed to investing purely in the name of one or both of those individuals. So let's look at a company. A couple could invest within a company that they set up. They will be directors and shareholders of that company. They could lend the company money via a shareholder loan. And then from there, the company could buy assets such as cash, property, shares, and they could also borrow money to invest, whether that was borrowing outside of the company or within the company, or a combination of those, which is more likely the case. Now, the benefit of this structure is that income can remain in the company and does not need to be distributed. Tax can be paid in the company at the corporate tax rate of 27%, and tax paid will accumulate tax credits in the form of franking credits that can then be offset on personal tax through distributions. So let me talk about that in a little bit more detail. So let's say that we have a company. We've got earnings of $100,000 or income, or it doesn't really matter what the number, but we'll just use an easy number of $100,000 in the company. The tax is paid at the company tax rate of 27%, which is $27,000. If in the future, when a shareholder looks to distribute a dividend, they will get that tax credit of $27,000, and then they will pay tax in their personal name at their marginal tax rate. Now, after they pay tax at their marginal tax rate, that $27,000 of franking credit, of tax credit, will offset. And what that means is that the shareholder will not be paying double taxation. You won't be taxed in the company and then taxed personally on the same distribution. You'll be taxed personally with the offset of the company. So utilizing a company really does help higher taxpayers, higher income earners, because they're capping their tax rate at 27%. And when they do distribute that income, they get that tax credit back. We've also applied this structure for clients that are going overseas for several years to work overseas, where they'll be taxed in that overseas jurisdiction. None of the money's coming back here. They don't have any personal assets here. So we invest all of their personal assets within a company, and that way they only need to generate the one tax return every year, which is the company return. And then when they come back, they can either pay themselves back their director loan, which will be tax-free, and any income that's distributed via, or profits, that are distributed via a dividend, we can have the franking credit come through to stop them from paying double tax. Any additional taxable income in that scenario can be knocked out using concessional super contributions, assuming there's room in their annual limit. But you can see the benefit of utilizing a company in that respect. Now, if the couple, as I said, pays more than 27% tax and doesn't need to distribute any income personally, then the strategy can be extremely tax effective, because at least they know they've capped their tax rate at that level. And as I said, we're going to get those tax credits accumulating. And there are also protection benefits, as the company is a separate entity. So if there's chances of litigation or whatever it may be, there's some protection of those assets that have been moved into that environment. Now, it's not all beer and skittles. Obviously, there are some disadvantages, and the main disadvantage to this strategy is that the company does not get the 50% discount on capital gains. So what that means is if I was to sell an asset, I've made $100,000 on my shares, I've held them for over 12 months, I'm not going to be paying tax on 50,000 of those. I'm going to be taxed at the company tax rate on the whole 100,000. Companies look at capital gains just like they look at income. So effectively, they'll be paying tax on the total gain. And as I said, that's at 27.5%. Sorry, that's at 27%. Now, if you're paying tax at the highest marginal tax rate, then the rate you're going to be paying, your effective rate you're going to be paying on your total capital gain is going to be 23.5% because we get 50% discount. So 50% of 47 is 23.5. In a company, we'll be paying at 27. So there's still an increase, but it's not a very significant increase. So it can still work for higher income earners, particularly if they've utilised or they're maximising all of their ability to make contributions into super. As we know, super is the most tax-effective vehicle there is. Now, companies also do cost more for upkeep, because you need to lodge your quarterly BASs and your annual return, and of course you've got an annual ASIC fee. So this is more work for an accountant. We work with many accountants which do an amazing job, but obviously there is a little bit more cost in terms of the upkeep. Now, when you think about it though, these costs are minimal compared to the large sums that would be invested and the amount of tax that would be saved within a company structure over the long term. So at the end of the day, there are costs, but in perspective, they're not huge. They're not huge costs. One point to note is that if you have a company that trades, let's say you've got a consulting business and you're running it through a company and you're giving some consulting advice and you elect to have that company be your investment vehicle as well, as we're talking here, then the company tax rate can fall to 25% if the passive investment income, the income coming from our assets, is less than 80% of the total income of the company. So we can get a little bit more of a tax break there. However, there is an issue here, and that is that if there's any risk of litigation or loss or anything that may happen from the trading business, having all your operations in one entity for the sake of saving 2% tax and some costs is not worth the risk of potentially losing your accumulated assets. So it's really important to note there that you don't want to be having your trading company, particularly if there's any risk of any type of litigation or compensation, you don't want to have that mixed up with your assets. Now, then we get to a discretionary family trust as another option, as another entity that we can invest in. Now, similar to a company, funds can be invested within the trust via a beneficiary loan, and then assets can be purchased. Again, there's no restriction on the assets that can be purchased. It's not a superannuation vehicle. So effectively, the assets that are purchased are based on what the investor feels is going to be suitable to achieve their goals and objectives, obviously with the help of some advisors such as ourselves. Now, the trust can borrow money, or the beneficiaries can borrow and lend to the trust as well. So again, there's no real limitations on how much can be invested within a trust. Now we get to the main difference between using a company for my investment or using a trust, a discretionary trust, in that the trust must distribute 100% of the net income to beneficiaries. Now let's talk about net income. So this is income after costs, any depreciation allowances, any loan interest that are within the trust. So if I've got a rental property in my trust and it's generating a $70,000 annual return, but I've got interest or annual rent, but I've got interest of $60,000 and depreciation allowance of say $5,000, I've only really got net income of about $5,000 that I need to distribute. Now, this income can remain in the trust, and in most cases it just remains in the cash account, but it has to be treated as if it's been paid to one of the beneficiaries from a tax perspective, right? So a lot of this is just on paper, but more on this soon and some of the strategies. Then comes the second largest difference, and the second main difference is that net capital gains that also need to be distributed, because everything has to be distributed out of the trust, on paper at least, individuals will still be able to keep their 50% capital gains discount for assets that they hold over 12 months. Now, this is a huge benefit because if I have an asset, again, within a trust, I sell that asset, I've made a capital gain of say $500,000 and we've got 4 beneficiaries within the trust. Let's just assume that they're all going to get an equal amount, but they don't have to, and we'll talk about that in a second. Then the $500,000 net capital gain will be reduced from $500,000 to $250,000, and then the $250,000, the $250,000 can then be distributed across the 4 beneficiaries, and then they will be taxed on 1/4 of that $250,000, assuming they're being distributed the same amount of money. So this is a huge benefit compared to a company where we are unable to get that 50% CGT discount. As I said, the income needs to be distributed to beneficiaries. And as a trust is a discretionary trust, the clients or the couple, whatever you like, have the discretion, sitting down with their financial advisor and their accountant, to elect beneficiaries at the end of the year where this income is going to be distributed, right? And this is really important. It's not only the income, but it's also the amount of income. So you can have a couple, one of them's earning a little bit more than the other. There's net income in the trust of say $50,000. One of them can get $20,000 and the other one can get $30,000. So you just sit down in front of your Excel sheet and look at the best outcome from a tax perspective of all the different combinations that you could look at in terms of making that distribution. As I said, a couple with different marginal tax rates really can sit down and get the most tax-effective strategy in terms of distributions. And when their kids, in terms of this case study, are over 18 and they've got the full tax-free threshold of $18,200 plus some of the tax offsets, which come to about $20,000 plus tax-free, we can distribute as much to them as we possibly want to be able to get the most effective, tax-effective use of that distribution on an ongoing basis. So clearly you can see the beneficiaries of a trust. Now, let's look at if one of the child beneficiaries over 18 starts working, right? Let's look at a scenario that's quite typical. They're at university or some sort of tertiary study and they've got a part-time job. Now, their part-time job is going to pay them an income and is going to withhold tax. Let's say that they have claimed the tax-free threshold from that employer, which is fine. Doesn't really matter which way it goes. At the end of the day, this extra income is going to be added to their taxable income in terms of calculating the total tax payable. In that respect, you're still going to get a benefit up to a particular level of income for your adult child beneficiary over the age of 18. Again, sitting down and figuring out the best combination that can be used in that respect. Now, let's look at this type of structure in terms of the full life cycle of a family unit with investing in growth assets. Now, this is something that we've been thinking a hell of a lot more about over the last probably 5 or so years than we were 15, 20 years ago because of this intergenerational wealth transfer that is occurring at the moment. A lot of our clients are looking at transferring wealth to their adult children in the most tax and cost-effective way possible. But at the same time, they don't want to wait till the funds are distributed through their estate because they don't get to see and enjoy watching their adult children and their grandchildren benefit from those funds. At the same time, their adult children are finding it very hard to get in the property market because obviously property markets have gone crazy. There's a limit of supply, and with the strong demand and limited supply, you're seeing a huge affordability issues in terms of people trying to get into the property market or upgrade their property to look at something that's going to be more suitable for a growing family. Now, as these investments, these portfolio of assets, which I like to call family assets, are accumulated within a trust or this type of entity, and then the children finish school, they enter the workforce and they look to enter the property market, income that is distributed to them through these trusts can be used for serviceability, to support their serviceability on a loan application when they go to buy their own home. And eventually, obviously, those distributions can help them fund a loan if they've got a larger mortgage. Plus, the capital value of the trusts, again, as their beneficiaries, can be used as a guarantee to help them purchase a property. So there are huge benefits in accumulating these family assets and being able to use those assets to help children prior to the death of the parents get into the property market or purchase assets themselves. So I like to look at these assets within a trust as family assets because they're gonna help across the whole life cycle. As the couple or the parents age and decide to leave work and enjoy retirement, distributions from those trusts can again help them supplement the retirement income. And they're going to be taxed at lower rates, because if they've got a certain amount of super, which is in a pension, we know that over the age of 60, that pension income will be tax-free. The only taxable income we're really going to have is going to be taxable income that's generated from the trust. So the full tax-free threshold on each of that retired couple is going to be utilised, and the tax rate on those distributions will be quite low. And then upon their untimely death, obviously one of the certainties of life is death and taxes, as they say. Assets that within a trust that will form part of their estate can be distributed to the children via what we call a testamentary trust, which is basically the same sort of structure, but it's on assets that are distributed from an estate, as opposed to just giving a distribution of a part of a portfolio to your children. It's basically allowing those assets to continue to have that longevity, basically for perpetuity, if you and your family like, and then having the income from those assets just being distributed to your child beneficiaries via that testamentary trust. Now, the testamentary trust will also help protect assets for your children from any marriage breakdowns or any other potential litigation or legal issues. So it's quite an advantageous structure to put in place, a structure that can be unwound very simply by the beneficiaries, but at the end of the day, it gives them the option, it gives them the flexibility of having those assets within that structure for that protection. As I said, there are many benefits here, and from all this detail, and there's quite a bit of it, you can see how beneficial personalised long-term financial planning can be for a couple or a family group as their family grows, as they look to retire and eventually retire, and then consider intergenerational wealth transfer, both pre-estate and post-estate. Generalised financial advice really doesn't work, is not going to allow you to tick these boxes in terms of getting the best outcome possible. Why? Because there's a lot of complexity out there, particularly for many Australians who are paying higher and higher amounts of tax, who have assets that are growing year on year, like the family home, and obviously have amassed quite a large amount of wealth. Now, let's look at another example where generalised advice is really pushing a lot of clients to be listening, watching YouTube videos, blogs, whatever it is, to promote a certain retirement structure for particular reasons, and where this can really turn out to be quite a disastrous situation. So the other example is really around the rise in self-managed super fund or SMSF advice over the years, which has really been huge. From our experience, we wouldn't have opened many self-managed super funds over the last maybe 10, 15 years ago, but over the last 10 years, we're seeing so much more adoption of self-managed super funds. In the past, SMSFs tended to be more so for business owners and for wealthy individuals. You've got your doctor who has their practice in their property, leases it off them, dentist, whatever it may be, or, as I said, warehouses for other small business owners. Now they're widely used by so many superannuation members. Why? Because we can borrow and invest in residential property using our super benefits. So huge benefit there, and I won't go into the benefits and applications of self-managed super funds, as this is another whole new topic of conversation and definitely for another upcoming episode. But when this more general type of advice that an SMSF is suitable for you, commonly today, strategy not suitable? When won't it work? The first scenario we normally talk about, and it's the easiest one, so I'll really cover it quickly, is in terms of portfolio balance. If we have a portfolio balance below $300,000 to $500,000, particularly around the less than 500,000, then the costs within a self-managed super fund are going to be a lot higher than what we could get outside of self-managed super. Whether we want to invest in a very simple, hassle-free, feature-free sort of industry fund, or whether we want to invest in something where we've got a bit more transparency, customization of investments, and tax benefits outside of the self-managed super fund world. So really, we want to be looking at 500k plus minimum before we start looking at self-managed super. And it's not just a cost scenario, it's also because of the fact that obviously majority of self-managed super fund investors these days want to buy property, and the last thing we want to do is concentrate all our wealth within one asset. That's a recipe for disaster, even if we are buying residential property in a capital city. Why? Because we need liquidity. At the end of the day, there are costs and you need liquidity. You need diversification. And without diversification and liquidity, you can have a lot of hassles and a lot of problems and a hell of a lot of stress. But let's specifically talk about time frame. And I want to talk about this in terms of a scenario that we've recently seen. So we had a client approach us who was recommended a self-managed fund, who was looking at retiring within the next 3 to 5 years. Superannuation amount was sufficient to allow for a property purchase in terms of a SMSF. We weren't going to have large issues around diversification or liquidity. We would have some liquidity. But the time frame is a major issue because, as we know, any growth asset, no matter if it's the property down the road, residential or a commercial property, or even a blue chip share like a BHP or a Rio Tinto or a Commonwealth Bank, you need time. Time is the only critical element, not the only, but the main critical element in investor success. At the moment, we've got great assets on the stock exchange, which are really experiencing heaps of volatility because of a lot of the geopolitical and economic issues that are happening out there. That's not to say they're not good assets just because they're going up and down in price. That's just to say that the market's uncertain as to what valuations should look like based on the economic environment we're in. You can't be buying a stock or an asset like that and then selling it within a short period of time. And with property, like with a good share portfolio, we need medium to long term, 7, 10 plus years. I would suggest with property, we really need 10 plus years at least. Why? Because it doesn't get valued every day. We can't gain on some of the valuations that come from a day-to-day perspective. And it's a large asset. It's a liquid asset. You can't sell part of it. You've got to sell all of it. So you've got to make sure that the price you're selling at is going to be the right price. Now, why is this an issue for this particular client? It's an issue because at the end of the day, the income from the rental property, as we all know, is not going to be enough of a yield, in this case, to be able to fund this client's retirement. Rental yields are quite low. And even if the borrowing level is very low, extremely or nil, we're still not going to have enough income to be able to fund our retirement. Now, if we've got most of our money in one asset, what are we going to do? Where are we going to get our funds from? So in this case, the suitability around SMSF, which was, I guess, more of a generalized, more of a common type of strategy as opposed to really looking at the client's objectives and timeframes and all that, you could see that it's just not suitable. Why? Because she's going to retire in 3 to 5 years. She can sell the property, but maybe it's at a loss because of the stamp duties and costs on purchase and upon sale within a short period of time. So it's really important, and you can see from these two examples, it's critical in receiving personalised advice based on your situation, whether you're working, whether you're looking to retire, your timeframes, your risk tolerance. It's, in this case, it's a form of protection, having that personalised advice, ensuring that wherever you're investing is really suited to your objectives. So no matter your situation or your goals, if you want good advice, it needs to be tailored to you. No matter if you're looking to enter the housing market with a family, with a growing family, like many in the northern beaches of Sydney, or you have older children and you're starting to focus on your retirement in 10 to 15 years, or whether you run a business and looking to diversify wealth that's generated from your business, or looking potentially at selling your business and moving on, whether you're looking to retire in the immediate term, and also considering how you're going to help your adult children effectively get into the property market and set themselves up by transferring some of the wealth that you've generated before or after your passing. In all these instances, tailored and personalised advice is the only way to achieve all your goals and objectives along your path to financial success, security, and independence. As always, this is not to be taken as advice and is definitely general in nature. I hope this discussion has been beneficial. If you've watched this on YouTube, please leave a thumbs up, subscribe, and leave a comment. If you're getting the non-YouTube version of this podcast from wherever you digest your podcast content, then please comment, like, and follow. Thank you. We really appreciate that. Lastly, this episode is brought to you by financial advisory firm Manly Financial Services. We focus on providing specialist financial advice to individuals and now working more and more with small to medium business owners and executives in that space. Please visit our website, manlyfs.com.au. Hope this discussion and information has been of benefit and engaging. If you'd like some more help, please reach out. Go on our website to connect. We'd be more than happy to have a discussion and to help where we can. Take care, and we'll see you in the next one.